By the end of the year, thousands of Florida homeowners were still paying their mortgages, but they no longer had insurance, and nothing had happened to their houses. For most people, home insurance is invisible. You pay a bill once or twice a year, you receive a document in the mail, and then you forget about it. The house stands, the policy renews, the system works because it's designed not to be noticed. In Florida, this had been true for decades. People bought homes near the ocean, in neighborhoods with palm trees and hurricane shutters, and they insured them the way everyone insured homes. It was a cost. It was required, but it wasn't a question. Lenders demanded it. The state regulated it. Companies offered it. The market functioned. No one thought the coverage itself could vanish. No one thought the product could simply stop being available. But starting in 2022, something began to change. Not in the homes, not in the weather that year, but in the willingness of insurance companies to continue operating in Florida. The change was quiet at first. A few companies announced they would stop writing new policies. Others said they were reviewing their exposure. The language was technical, the impact seemed distant. But beneath that language, a structure was beginning to fail, and homeowners, who had assumed their coverage was permanent, were about to discover that it was not. Insurance exists because risk is unpredictable, but calculable. A single person cannot afford to rebuild their home after a disaster, but if thousands of people each pay a small amount, the collective fund can cover the few who experience loss. The company collects premiums. It estimates how many claims will occur. It sets aside reserves, and it profits from the difference. The system depends on balance. If claims are too frequent or too severe, the company loses money. If premiums are too high, customers leave. In Florida, this balance had always been fragile. The state sits on a peninsula surrounded by warm water. Hurricanes are not rare, they are expected. But for years, the math still worked. Companies charged higher premiums in Florida than in other states. They used reinsurance to spread their risk globally. They built models to predict losses, and they stayed. The market was competitive. Homeowners had choices. Coverage was expensive, but it was available. Then the variables began to shift. Hurricane frequency increased. Construction costs rose. Litigation over claims became more common. Reinsurance became more expensive, and the models that had predicted manageable losses began to show something else. The math was no longer holding, and insurance, which had seemed like a permanent feature of homeownership, was about to become optional for the companies themselves. The claims began to rise in waves, not just from hurricanes. Florida's insurance system was under pressure from multiple directions. Roofs damaged by storms were being replaced under policies that covered wear and tear. Contractors began going door to door, offering free inspections and encouraging homeowners to file claims. Lawsuits over claim denials became routine. Florida's legal environment allowed homeowners to recover attorney fees from insurers, which made even small disputes expensive to settle. The state also had laws that made it easier to file claims for roof damage, even if the damage was minor or pre-existing. Insurers began paying out more than they collected. By 2021, Florida accounted for nearly 80% of all homeowner insurance lawsuits in the United States, despite representing only 9% of claims. The legal costs alone were enough to destabilize smaller companies. Then came Hurricane Ian in September 2022. It made landfall as a Category 4 storm near Fort Myers. The damage was catastrophic. Entire neighborhoods were flooded. Homes were torn apart. The insured losses reached over $50 billion. For many insurers, Ian was the breaking point. They had already been losing money, they had already raised premiums, and now they faced claims that would exceed their reserves. The question was no longer whether they could stay profitable in Florida. The question was whether they could survive. The pullback started before Ian. In 2021, a company called United Property and Casualty went insolvent. Then another, and another. 6 insurance companies failed in Florida between 2020 and 2022. Others stopped renewing policies. They didn't announce it in press releases. They didn't send warnings. They simply sent non-renewal notices to policyholders, stating that coverage would end on a specific date. Homeowners opened their mail and discovered they had 90 days to find new insurance. Some managed to switch to another company, but the options were shrinking. The largest national insurers had already limited their exposure in Florida. State Farm stopped accepting new homeowner policies in 2009. Others followed. The companies that remained began restricting what they would cover. They excluded certain roof types. They required higher deductibles. They refused homes within a certain distance of the coast. And they raised premiums. In some cases, premiums doubled. In others, they tripled. Homeowners who had paid $2,000 a year were suddenly being quoted $6,000 or $8,000 or more. For some, the increase made homeownership unaffordable. For others, it was simply impossible to find any company willing to offer coverage at all. The market wasn't adjusting, it was collapsing.
The cancellations arrived by mail, form letters, polite language, no coverage after this date. Please seek alternative arrangements. There was no appeal, no negotiation. The company had decided to exit the market or to reduce its exposure, and individual policyholders had no leverage. For those who received the letters, the next step was to search for a replacement. But the market had fundamentally changed. Many of the remaining insurers were small, Florida-only companies with limited capital. They were riskier, their premiums were higher, and their ability to pay claims in the event of a major hurricane was uncertain. Some homeowners were pushed into Citizens Property Insurance Corporation, a state-run insurer of last resort. Citizens had been created to provide coverage when no private company would, but it was never designed to be the primary market. By 2023, Citizens had over 1 million policies. It had become the largest insurer in Florida, and it was backed not by private capital, but by assessments that could be levied on all policyholders in the state if a disaster exceeded its reserves. This created a new risk. A major hurricane could trigger assessments on every insurance policy in Florida, even for people who were not Citizens customers. The safety net was now a shared liability. And for those who couldn't get into Citizens or who couldn't afford the premiums, there was only one option left: go uninsured. The price increases were not uniform. They were targeted. Homes near the coast saw the steepest hikes. Older homes with original roofs were quoted premiums that exceeded their mortgage payments. Homes with prior claims were deemed too risky. In some zip codes, the average premium rose by 40% in a single year. In others, coverage became unavailable at any price. The reasons were structural. Reinsurance costs had spiked globally. Reinsurers, the companies that insure insurance companies, had suffered losses in Florida and were demanding higher premiums or refusing to offer coverage altogether. Without reinsurance, primary insurers couldn't take on enough policies to remain viable. Litigation costs continued to climb. Roof replacement claims, which had been a steady source of expense, became unsustainable. Insurers began requiring roof inspections before issuing policies. They excluded roofs over a certain age. They refused homes with certain materials. And they built the cost of expected legal battles into every premium. The result was a market where only the newest, most disaster-resistant homes in the safest locations could obtain affordable coverage. Everyone else was priced out or denied. For buyers, this changed the math of homeownership. A house that was technically affordable became unaffordable once insurance was factored in. And sellers discovered that homes without access to insurance were difficult to sell. By 2023, parts of Florida had become effectively uninsurable through the private market. This did not mean the homes were uninhabitable. It meant that no company was willing to bet on their survival. The homes were still occupied. They still had value. But the financial system that had supported them was withdrawing. For homeowners with mortgages, this created a crisis. Lenders require insurance. If a homeowner cannot obtain coverage, the lender can force-place a policy at the homeowner's expense. These forced-placed policies are expensive and offer minimal coverage. In some cases, they cost more than the original mortgage payment. Homeowners who could not afford the new premiums faced a choice: pay the force-placed policy, sell the home, or risk foreclosure. For those who owned their homes outright, the choice was different. They could go uninsured. They could take the risk themselves. But this meant that a single hurricane could erase their wealth. And unlike insured losses, uninsured losses offer no recovery. The house is gone, the value is gone, and there is no claim to file. Some chose to take that risk, others moved. But the underlying problem remained. The homes were still there, the risk was still there, and the system that had been designed to manage that risk had stopped functioning.
The real estate market began to freeze in the hardest-hit areas. Buyers could not get financing without insurance. Sellers could not offer homes that were uninsurable. Properties sat on the market for months. Price reductions followed. But even at lower prices, transactions were difficult to complete. The problem was not just cost, it was availability. A buyer might be willing to pay a higher premium, but if no company would issue a policy, the sale could not proceed. Real estate agents began advising clients to avoid certain neighborhoods. Appraisers factored insurance availability into valuations. Lenders became more cautious. The effect was a segmentation of the market. Newer homes in safer areas retained their value. Older homes near the coast lost buyers. And in some communities, turnover stopped almost entirely. This had broader consequences. Local tax revenues depend on property values. If homes cannot be sold, values stagnate. If values decline, tax income falls. And the services those taxes fund, schools, infrastructure, emergency response, become harder to sustain. The insurance crisis was becoming a municipal crisis, and it was spreading beyond individual homeowners to entire regions. The state of Florida responded with a series of reforms. In late 2022, the legislature passed laws aimed at reducing litigation. They limited attorney fees in insurance disputes. They tightened the rules around roof claims. They created incentives for insurers to return to the market. The goal was to stabilize the system, to make Florida attractive to insurers again, to reduce the cost of doing business. But the reforms took time to implement, and they did not address the underlying risk. Hurricanes were still hurricanes. Coastal exposure was still coastal exposure. Reinsurance was still expensive. Some insurers did return. New companies entered the market backed by private equity and betting that the reforms would work. But they were small. Their capacity was limited, and their long-term viability was uncertain. Citizens, the state insurer, began a depopulation effort. It tried to move policies back to private companies. It offered incentives. It raised its own rates to make private options more competitive. But the gap between Citizens and the private market was still large. For many homeowners, Citizens remained the only option. And Citizens itself was not designed to handle a catastrophic event. If a major hurricane hit and exceeded its reserves, the assessments on all policyholders could be severe. The reforms had slowed the collapse, but they had not reversed it.
Florida today is a divided market. Some homeowners have stable coverage. Others pay premiums that consume a significant portion of their income. And some have no coverage at all. The homes are still there. The streets are still the same, but the assumption that ownership includes protection has been broken. For decades, insurance was a given. It was part of the infrastructure of American home ownership. You bought a house, you insured it. The system worked. But in Florida, that system is fractured. The companies that provided coverage have either left, failed, or retreated to the safest segments of the market. The state has stepped in, but it cannot replace the private market entirely. And the risks that drove insurers away, hurricanes, litigation, rising costs, have not diminished. What remains is uncertainty. Homeowners do not know if their policies will renew. Buyers do not know if they can get coverage. Sellers do not know if their homes are saleable. And the state does not know if the reforms will be enough. The collapse was not sudden. It was not announced. It happened in pieces, one non-renewal notice at a time, one failed company at a time, until the market that had existed for generations was no longer there, and thousands of people, still living in their homes, still paying their mortgages, discovered that the protection they had assumed was permanent had quietly disappeared.